Imagine a world where your livelihood, your entire year's work, could be wiped out in an instant by a sudden storm or a bumper crop. For early American farmers, this was not a hypothetical. Price volatility, driven by unpredictable harvests and the slow pace of information, was a constant threat. A surplus could crash prices, leaving them bankrupt, while a shortage could send food prices skyrocketing in distant cities, leading to hunger and unrest. Farmers lived on a razor's edge, praying for good weather and fair markets. In the mid-1800s, as America expanded westward, vast quantities of grain began pouring from the fertile prairies into rapidly growing cities like Chicago. This boom, however, presented a logistical nightmare. Transporting, storing, and selling these immense harvests efficiently was a colossal challenge. Without standardized practices, every transaction was a negotiation, ripe for disputes over quality and quantity. The nascent agricultural industry was bursting at the seams, desperately needing order. Chicago, strategically located at the crossroads of rail and water routes, quickly became the central hub for grain trade. Merchants gathered, eager to buy and sell, but the system was chaotic. Farmers would often dump their entire harvest onto the market at once, driving prices down. Then, during the lean months, prices would surge, benefiting only those who could afford to store. This feast or famine cycle benefited few and destabilized the entire supply chain, crying out for a solution. The spot market, where goods were bought and sold for immediate delivery, was inherently inefficient. A farmer might travel for days only to find prices had plummeted since he left home. Millers and bakers struggled to secure future supplies at a predictable cost, making business planning nearly impossible. Everyone involved, from the grower to the consumer, was at the mercy of short-term supply and demand fluctuations. It was a financial gamble with every transaction, hindering growth. To combat this volatility, merchants began to experiment with to-arrive contracts. These were informal agreements to buy or sell a specific quantity of grain at a set price for delivery at a future date. A miller might agree to buy wheat in 3 months, securing his cost, while a farmer could sell his anticipated harvest, guaranteeing income. It was a small, localized innovation, but it planted the seed for something much grander, the idea of formalizing future commitments.
In 1848, a group of 77 Chicago merchants, recognizing the need for order, founded the Chicago Board of Trade. Its initial goal was modest: standardized grain grades, weigh scales, and trade rules. They sought to bring transparency and integrity to the chaotic market. But crucially, they also began formalizing the to-arrive contracts, laying the groundwork for a revolutionary financial instrument that would forever change how the world dealt with risk and uncertainty. These early to-arrive contracts were tailored to specific needs, but they lacked uniformity. Every agreement was unique, making them hard to trade and creating a fragmented market. Imagine trying to compare apples and oranges when you need to make a pie. The genius of the Board of Trade was in standardization. They began to specify uniform quantities, qualities, and delivery months for these contracts, making them interchangeable or fungible for the first time. This was a critical step. By 1865, the Chicago Board of Trade formally introduced the futures contract. Unlike to-arrive agreements, futures were fully standardized, guaranteeing delivery of a specific commodity at a future date for a predetermined price traded through a clearinghouse. This system removed counterparty risk, ensuring that both buyer and seller fulfilled their obligations. It created a liquid, tradable asset out of future price expectations, transforming mere promises into powerful financial tools. At the heart of this new market was the pit, a sunken, octagonal trading floor where brokers and traders screamed, gestured, and battled for prices in a bewildering ballet of commerce. This open outcry system, though seemingly chaotic, was a highly efficient mechanism for price discovery. Information was disseminated instantly, and millions of dollars changed hands with a nod or a shouted word. It was a sensory overload, but it worked, creating genuine market prices in real time. The early days were not without their challenges. Skepticism abounded, and attempts at cornering the market or pools were frequent. Powerful individuals tried to manipulate prices by buying up vast quantities of a commodity. The board had to constantly evolve its rules and mechanisms to prevent such abuses and maintain market integrity. It was a continuous battle between the forces of honest commerce and those seeking unfair advantage, defining the very nature of organized trading.
The economic benefits, however, quickly became undeniable. Farmers could hedge their crops by selling futures contracts before harvest, locking in a profitable price and insulating themselves from sudden market drops. Millers and exporters could buy futures, securing their costs and allowing for stable business planning. The futures market provided a crucial safety net, transforming farming from a desperate gamble into a more predictable and sustainable enterprise for millions. As the CBOT's success became evident, the concept spread. Other commodities, such as livestock, butter, and eggs, soon found their own futures markets. The underlying principle remained the same: bring order to chaos, standardize the unpredictable, and allow participants to manage risk. What started with grain in Chicago soon laid the groundwork for managing volatility across an ever-widening array of goods, vital to the growing American economy, from the farm to the factory floor. The rise of the telegraph and later the ticker tape dramatically expanded the reach and influence of the Chicago Board of Trade. Price information, once confined to the pit, could now be instantly transmitted across the continent and eventually around the world. This real-time data allowed distant farmers and merchants to make informed decisions, further integrating regional markets into a unified national and then global system. Information was truly power, democratized by technology. By the turn of the 20th century, the Chicago Board of Trade was no longer just a local phenomenon. It had become a global benchmark. World grain prices were often dictated by the frenzied activity in its pits. Governments, industries, and agricultural producers across continents relied on CBOT prices to inform their economic decisions. This muddy patch of Chicago had, through sheer innovation, positioned itself at the nexus of global agriculture and finance, an unseen hand guiding vast economies. A critical, often misunderstood, component of futures markets is the speculator. These individuals, sometimes derided as gamblers, trade purely on anticipated price movements without intending to take physical delivery of the commodity. They are essential. By willingly taking on risk, speculators provide crucial liquidity, ensuring that hedgers can always find a counterparty for their contracts. Without them, the market would be far less efficient, and risk management much harder.
The CBOT played a critical role during major historical periods. During the American Civil War, it helped finance the Union effort by stabilizing commodity prices and providing a mechanism for the government to procure supplies. In subsequent decades of rapid industrialization, its efficient markets ensured that raw materials were reliably priced and delivered, fueling economic expansion. It was an unsung hero behind the scenes, providing the financial plumbing for a growing nation. The efficiency of the futures market had a profound effect on industrial growth. Companies could now plan years in advance, knowing their raw material costs. This predictability spurred investment, facilitated large-scale production, and ultimately drove down consumer prices. The system allowed for massive economies of scale, making goods more accessible and affordable for ordinary Americans. From your morning bread to your automobile steel, the unseen hand of futures was at work. With great power came scrutiny. As the CBOT's influence grew, so did calls for government oversight. Critics worried about market manipulation and excessive speculation. Over the decades, various acts like the Grain Futures Act of 1922 and the Commodity Exchange Act of 1936 were passed, establishing regulatory bodies like the Commodity Futures Trading Commission. This ongoing dance between market freedom and public protection continues to shape financial markets today. The innovation didn't stop at agricultural products. In the 1970s, the CBOT broke new ground by introducing financial futures, starting with interest rate futures on government bonds. This allowed investors and institutions to hedge against fluctuations in interest rates, just as farmers hedged against grain prices. It was a paradigm shift, expanding the power of futures from tangible commodities to abstract financial instruments, revolutionizing modern portfolio management and risk mitigation. The clamor of the pit, once the heartbeat of global trade, began to fade in the late 20th century. Electronic trading platforms emerged, offering speed, efficiency, and global access far beyond what open Outcry could provide. By 2007, the last vestiges of the storied open Outcry system at the CBOT gave way to screens and algorithms. A new era of instantaneous global 24-hour trading had arrived, marking the end of a colorful, iconic chapter in financial history.
Today, the legacy of the Chicago Board of Trade lives on as part of the CME Group, a global leader in derivatives markets. From agricultural commodities to energy, metals, currencies, and stock indices, the instruments conceived in that muddy Chicago pit now underpin virtually every sector of the global economy. Their innovations continue to shape how businesses manage risk, how investors allocate capital, and how prices are discovered for essential goods and services worldwide. Yet, the power of futures markets is a double-edged sword. While they offer vital tools for hedging and price discovery, they also present opportunities for excessive speculation and, potentially, market instability. The global financial crisis of 2008, for instance, highlighted the complex interplay of derivatives and systemic risk. Regulators and market participants continuously grapple with finding the right balance between innovation and oversight in these vast, interconnected systems. Ultimately, the story of the Chicago Board of Trade is a testament to human ingenuity in the face of uncertainty. From simple to-arrive contracts to complex financial derivatives, its journey illustrates how a fundamental need, the desire to manage future risk, can spawn revolutionary financial tools. It democratized economic opportunity, stabilized commerce, and created a more predictable world, proving that even the most abstract financial instruments often serve the most concrete of human needs. So the next time you enjoy a meal, fill your car with gas, or see a news report about global market prices, remember the legacy of that muddy Chicago pit. Remember the vision of those early merchants who dared to standardize the future. They didn't just create a market, they forged an invisible hand that continues to feed the world, manage its risks, and drive its financial engine. It's a reminder that true innovation often starts small, addressing a clear problem, and then grows to reshape empires. The story of the Chicago Board of Trade underscores a profound truth. Behind every seemingly complex financial mechanism lies a human desire for certainty and stability. From hedging against a bad harvest to protecting against currency swings, the quest for predictable outcomes drives innovation. And in that pursuit, we sometimes build systems so powerful, so intertwined with our daily lives, that their origins are forgotten, even as their influence remains omnipresent, shaping our economic destiny.